Okay, folks, welcome back. We have the economic calendar in front of us for June 24th through the 28th, 2019. All right, on Monday we have German IFO, business climate for Euro, running the London Open. On Tuesday, we have OPEC meetings all day. 8:45 a.m., dollar, medium impact FOMC members speaking. 10 a.m., dollar, consumer confidence, high impact and medium impact Richmond Manufacturing Index. And at 1 p.m., we have Fed Chair Powell speaking, high impact, so that's going to probably cause some movement in the marketplace. And at 6:30 p.m., we have another member speaking, medium impact, and the time we're not really concerned about. On Wednesday, we have inflation report hearings for GBP, 5:15 a.m. at the tail end of London Open. 8:30 a.m. news embargo list for dollar index, high impact core durable goods orders. And on Thursday, we have German preliminary CPI for Euro. 8:30 a.m. news embargo lifts again for New York session. Dollar index, high impact final GDP, and G20 meetings all day begin on Thursday. Friday, London Open, GBP, high impact current account and final GDP. 5 a.m. we have Euro CPI flash estimate, and 8:30 a.m. news embargo list for once more, and high impact GDP for Canadian dollar, RMPI, and dollar index, medium impact core PCE, price index, and personal spending. At 9:45 a.m. we have Chicago PMI, and 10 a.m. we have revised consumer sentiment. At 10:30 a.m. for Canadian dollar, we have the Bank of Canada Business Outlook Survey, which is high impact. Then finally, G20 meetings, day 2, all day for Friday. All right, so let's take a look at the charts now. All right, so we have the dollar index here. You can see we have the days broken up with true day. And I mentioned this on Wednesday, see if we had any interest to get back up in here. We did not. So when it didn't do that, this is a breakaway gap. So that means they're going to be very, very aggressive, if you will, about wanting to take price lower. We have a fair value gap in here. You'll be able to see these clearer when we drop down into a 15-minute time frame. We had a nice retracement in here back into equilibrium to take us into another level of selling. Previous ranges here to here, sell off again. Nice return back to a rejection block, highest up close candle here, distribution. Bearish order block, mean threshold there, and expansion on Friday. Okay, if we drop down to a 15-minute time frame for the dollar index, you can see that fair value gap in here. This is the point at which you want to trade back to, or the institutional order flow entry Joel technique. And the 47 level would be needed to be traded back to. It does so here. That's your fill. You don't need to fill the entire gap. Distribution, another fair value gap in here, trades into it as well, consequent encroachment. Distribution, another fair value gap in here. Your fill would be on this candle, because it's this candle here. And the reason why I don't have all the annotations showing fair value gaps, you can clearly see how fast this would clutter the chart all up. So we have a fair value gap here, we have a fair value gap here, and then we have liquidity pool back to mitigation block. Closed candles, creating a run lower. This is not a breaker. Okay, it's not a breaker. We trade back to mitigation here, and one more time here. So any longs they were trying to accumulate, they had to switch gears on that. And another level of distribution. Equal highs, fair value gap, volume imbalance, and fair value gap. Price comes back, fills that in. Distribution, fair value gap, one more time, fills it. Distribution, comes back in. Bearish order block, distribution, breaker here. What's it running? The swing high here. And this is a 15-minute time frame. They still work on those time frames. The order flow is bearish. Okay, we were looking for a bearish dollar. We mentioned this on Wednesday. We were just using this point to measure if we had an interest to get back up in there. It doesn't have to do that, remember. But every time we create another opportunity or premium array, to sell short at, the market has a expansion to the downside, clearly depicting bearish institutional order flow. Now the points between the two vertical lines here, this is like dead time. We're not really concerning ourselves with a whole lot of that because that's where we do our flout, central bank dealers range, and Asian range measurements for standard deviations for intraday volatility. So the points at which from 04 to 20 here, this is the true daily range. This is what we like to see for price structure, for patterns. And before I get into it, if I don't say this now, I'm going to forget about it. So if we have the last lesson in mind, okay, so when I stated where high probability fair value gaps form, I mentioned that when they form with a kill zone. Now, I'm not stating that the actual fair value gap forms, okay, or creates the gap in the kill zone. I'm saying that if we return back to it, okay, or trade back into it, okay, that moment is when, because that's when the setup is valid, okay. Just because we created a gap, on 3 candles during a kill zone, it may not trade back to that level until a day later, okay, or even a week later. It doesn't matter that it forms during or outside of a kill zone. The return back to a fair value gap during a specific kill zone, that's Asia, London open, New York open, and London close, and New York close. So those time periods when they're trading back to the fair value gap during a kill zone, that's what's important. It's not that they have to form, okay, the gap itself does not have to form during a kill zone. For instance, we're seeing the dead space in here. We create the fair value gap there, okay? It trades up into it. It forms and fills during the Asian range. So you can get into that because it's during the Asian session. But for the daily range, in other words, after the accumulation distribution portion of the day, New York, midnight. This time, once we transition from here and we leave the central bank dealers range, flout, and Asian range period, again, this is like dead time. We use this to get our measurements for the daily range, how far the daily range can move higher or lower. Fair value gaps can form within these dead times and trade back to them during a kill zone. That's the point at which it makes it high probability. So don't be confused by my not being so specific about it in the lesson, where do high probability fair value gaps form. The gap itself can occur or form anytime. But when they're traded, what makes them high probability is when they trade back to those gaps at a specific kill zone. Because during a kill zone, you have a large degree of liquidity entering the marketplace, and they're going to pair orders. So when we look at these levels of inefficiency, like BISI or SIBI, the fair value gap will create a specific price point at which we want to enter during a high probability time of day, which is the kill zone. Okay, so it doesn't have to form during a kill zone. The setup will form when it returns back to the fair value gap during a kill zone. So hopefully I've made that clear. I got a couple people email me that, and I've just answered your question there, so I will not be answering by way of email. All right, so let's go into the euro dollar. Don't really make this video too long this week. All right, so we have the hourly chart here. It looks a little bit busy. I realize that. The order block in here, fair value gaps, and breaker. We mentioned this on Wednesday. We didn't have any kind of real interest besides this distribution in here. We swept the equal lows. Beautiful run down. The accumulation on the upside ran buy-side liquidity. I mentioned that I didn't like this structure for a market maker buy model. I stated that it could happen, but my focus was primarily on if I was going to trade between euro or cable, it would be on cable. But then later on, you heard me say, now, if I'm going to choose between cable or dollar CAD, I trusted more in the sell in dollar CAD than the longs on cable. So I went through the process of actually what I do when I look at charts, because everyone asks all the time, how do I pick the ones that I want to trade. Sometimes I'm wrong. I mean, let's just be real honest with it. Sometimes I'm just wrong, and that's okay. There's nothing wrong with being wrong. Okay, it's normal. It's going to happen. It's not about being right. Now, I stated that I personally did not like the structure of Eurodollar, and I didn't trust it to perform for me to trade on it. So we're talking about Wednesday to Friday. So our Wednesday review, I stated that I wasn't really keyed up on Eurodollar. It could do it, and it did, but it's fine. I didn't participate in it. I'm not interested in it. What I was more concerned with was, do we have that same signature showing up in cable? Because I trusted cable more than Euro. Now, in a perfect world, in a symmetrical market, both Euro and cable will move in tandem. They'll move in the same direction, especially if we have a directional bias, which we finally arrived at on Wednesday. It was very clear. We were confident. And this is what I mentioned for the newer students, because a lot of the new folks are just, you're really impatient. You're really, really impatient. And I understand you're excited. You want to get into things. You want to see things working. And some of you just started where I wasn't real clear. But I always state, every single week, I'm going to find something. Okay, I'm going to find something. Now, it may not be during the weekly reviews like this one here. Okay, it may require the Wednesday review. But I'm looking for 50 to 75 pips a week. That's my style. That's me. That's what I'm looking for. And everything I point to, if you go back and look at the videos, they're pretty consistent in finding those next 50 to 75 pips every single week. I'm telling you the process like I did last Wednesday. I see the potential, and I admitted that I could be wrong and it could still go up and create a market maker buy model. But I won't be participating in this one. And I stated the reasons why. Go back and watch that video. Now, because I transitioned from the desire of wanting to trade Euro and electing to be more interested in cable, I showed you my internal dialogue. I shared it with you live as I looked at the charts. So it's not something I had in a preconceived note, okay, or a script that I was following, because rarely do I have a script. I have bullet points on things I want to mention. But other than that, I'm kind of going over the charts live with you at the time I'm doing the reviews, because I don't have a whole lot of free time anymore. So the process that I go through, I kind of like revealed it to you last Wednesday, where I look at certain things and then I measure the weight on factors. I mentioned that how Eurodollar had higher lows versus cable, and even though that was the case and it had relative strength over cable, I elected to trust cable more. And the only reason why, if I'm going to mention anything fundamental, is because Draghi had a lot of talking, and he still has some things to say probably this week, as we mentioned on the economic calendar. I did not feel that they were going to be that impactful for cable. Okay, so I viewed all the Draghi the talks that he's going to be doing, the speaking. That's going to be a high-level manipulation. So I don't trust that. I expect it to create problems for me. It just so happens that this one panned out pretty nicely. They ran up, cleared the buy-side liquidity pool. Beautiful. Nothing wrong with that. It's something I just let go. You're going to miss things too. You're going to see things that might be there, but you're not going to trade them. And then when they happen, you can spend all your time going on social media complaining about how hard it is, or you should have did this or should have did that, or just mentally complain to yourself how you didn't do something. Or you can just say, okay, I felt that it could have done it. I didn't trust it. It still did it. Okay, no problem. I didn't lose any money. It was a missed opportunity, but you followed your plan. And that's all I did. I shared my plan on Wednesday. I didn't want to do anything with Eurodollar. So let's look at what has transpired from Wednesday to Friday. Here's Wednesday's trading. We had a really nice run here during the dead period of time between Wednesday and Thursday's London Open. So we had a fair value gap forming here, which we'll see on the lower time frame 15-minute chart. And we have a bullish order block, which it trades down to later on as well. And then we have the expansion on Friday. Bullish order block runs and then expands above the buy-side liquidity pool. What I want to talk about in here briefly is the fair value gap that we had outlined prior to Wednesday. I said that we would run up into that. We did that. We did it on Thursday handsomely. Watch what happens when price gets above it. It finds support right at that fair value gap. Notice that? I love when I see that. This is one of those signatures. When you hear me talk about when price creates certain signatures. Okay, this is something that IPTA does always. When you find a fair value gap, it acts like, when folks that aren't really familiar with what I'm doing, they see me draw these little rectangles on here, okay, and they say, oh, right away, that's supply and demand. And it's not supply and demand, because there's nothing in supply and demand that teaches you this inefficiency, and then it comes back and finds it as support. We used it as a draw on liquidity initially. Then once it hits that, it becomes a balanced price range. That's not in supply and demand. Once price trades above it, then it acts as a real, tangible support level. What makes it support and it makes it tangible? What makes it more or less a high probability support level? The fact that we had an imbalance, it's been rebalanced, and then we went back above it. So when it comes back down, what is it reaching into? A level of liquidity, but it's also being defended. What's defending it? IPTA. There's no necessity for, once it trades back above it, once it comes back down into it, we can reasonably expect it to act as a traditional support level. Okay, so whenever you see fair value gaps, and you can see it here as well, the fair value gap here, it's not drawn out. Extend that out in time. Price comes back down into it, hits it, finds support. At the same time, it finds another lower level fair value gap, which we'll see on the 15-minute time frame, and the bullish order block. So you have three confluences there at this period, right there. Time of day that this forms. London close. Okay, so again, kill zone, fair value gap, which we'll see on a 15-minute time frame, bullish order block, and then returning back to a SIBI, which is a sell side balance, buy side inefficiency. The balance is happening here, and then we trade above it and come back down into it. It's going to act as what? Real, tangible support. Okay, so when we have these levels like this, then it's fruitful. But notice this is happening on Thursday. Now, we discussed things over here on Wednesday. I mentioned that we would see it trade up at here, trade up in here. We saw that. And then we have liquidity pools, obviously, here. Nonetheless, whenever you have your fair value gap and it fills, don't just throw it away. Okay, those are real, tangible points of reference. Okay, they're going to be points of institutional order flow, and what they are is balanced price ranges. Once there's an inefficiency there, it creates the opportunity for price to trade back to it. So that's what IPTA does. But once it rebalances that, you want to keep those same ranges on your chart, because that's going to be a real quote-unquote supply and demand zone. Okay, but it's not the zone that we're interested in. It's the actual high or low. That's all we're concerned about. We don't try to figure out what's happening inside of the range or the fair value gap. We're not worried about that. We're not trying to guess. We don't even need to do institutional pricing in it. We're just going to use the high end or the low end once it trades above or below it, respectively. We'll talk more about this. Don't think I'm done with it. There's other things we got to talk about, and I'll teach more on balanced price ranges because there's a lot to talk about. Like I said, there's so many things that I'm going to be teaching you, but there has to be some graduated understanding with the core content, and then it becomes a lot more clear. Okay, so all right, so we're in a 15-minute time frame for the euro dollar. You can see on Thursday we had the fair value gap here, right in here, and then we have price trade down into it, fill it. One more time, retrades back into it, bullish order block, optimal trade entry, several things there, and then price creates relative equal highs below a period of relative equal highs over here. The market maker buy model states that we need to run the liquidity above the equal highs, and we see price creating fair value gaps in here, returns back into it, and another expansion on the upside. Beautiful, beautiful delivery of price on Friday. On cable, here's what we have, that May 31st, old daily low. We had sell side liquidity. It was ran out here. I mentioned that we went to the mid figure 25.50. When it does that, we treat it with not just a simple 10, 20, 30 sweep on stops. The mid figure and the big figure levels can see IPTA swing 40 pips. Okay, and that's what we saw here. I mentioned it has done that, and then once it sweeps that, it's free to trade on the upside. with a bearish dollar. Price sweeps again, as I mentioned on Wednesday's review, below that May 31st daily low, and then expands to the upside. Buy side liquidity is ran out. And then we had the fair value gaps, which we'll see again on the 15-minute time frame as upside objectives, and then equal highs buy side liquidity pool. This equal high buy side liquidity pool is still in play. They will be looking to seek the liquidity above that this week. Eurodollar's already did it. The cable still has to expand on the upside. Now we do have relative equal highs here that was formed on Thursday and during the dead time on Thursday to Friday's trading. Traded all the way down into a fair value gap, which we'll see again on a 15-minute time frame once we drop lower. Then we have bullish order block as well. That's what's being depicted here. And then a beautiful expansion on the upside. This right here, this 100 pip move, is exactly what I was referring to when I said I would favor the cable over euro. If you look at the original consolidation, we break down, return to the consolidation, distribution, not so clear on a 1 hour chart. When we get down to the 15-minute chart, you'll see it. Another level of distribution, smart money reversal, low risk buy, reaccumulation, and then we're going to be running the buy side liquidity pool for next week. That's our objective. Now you're probably saying, well, it's only 20 pips or so, Michael. Well, that's still something to be watching. It could still gap up open on Sunday and get that way, but we'll talk about that when we get back into the daily charts. I'm going through the lower time frames first. All right, on the 15-minute time frame, again, we can see that buy side liquidity pool, equal highs. Easy. Whenever we see these, we know exactly what we're looking for. Fair value gap in here. This is where the fair value gap would have its low end. High end is here. This candle on 15-minute time frame, fair value gap trades to it here beautifully. And market structure breaker trades down into the breaker, expands, buy side liquidity pool equally is effective on a short-term trade and leaving a portion on for 127.62 to 65 buy side liquidity. Really nice price action on cable. Even though for euro, I mean, euro had a nice run here, but look how back and forth it is. Yes, it creates fair value gaps, but it's real spiky, and it's just, this is what I'm talking about. I don't like to see these types of days. Now look at this, contrast this. Let me zoom in a little bit. Contrast this price action, okay, and they both relatively had almost very similar in terms of pips, but cable did outperform. The low on euro on this Friday that passed was 112.82, and the high came in at, I can get the show up here, 77. So we didn't get 100 pips, but on cable we had the low. The low on cable comes in at 41, and the high is 46. Okay, so we had over 100 pips move between the 27 and 26 40 levels, okay, or 41s. So beautiful outperformance again, mentioned beforehand, that we would see cable do a better job of creating IPTA displacement and delivery of price on the upside than cable. I'm sorry, than over Eurodollar. So if we know that this is what we're looking for next week, it's very short in terms of the magnitude at which it should be moving from where we closed on Friday to where we're looking for. It could go to 127.80. Obviously, institutional level 127.80 is next institutional level above 127.62. So those levels are something to watch. Going over to dollar CAD, this is the one I said I was focusing more on than between cable and euro. We had a nice sell-off on Thursday after we mentioned on Wednesday. It was very heavy. It's going to look to run into its bullish order block and fair value gap, rebalance, all that. It did that rather impressively. If you drop into a 15-minute time frame, here's Thursday's trading. Nice little fair value gap in here. Here's an opportunity here at 32.16 down to 31.65 it looks like in here. Let's see what that low is. No, 61, a little bit more than that. So that's a trade in itself. Trade down into a bullish order block, fair value gap, close that, it's done. Short, buy it back, handsomely handled. So we also have a fair value gap in here. This one single delivery on the downside. This candle's high, this candle's low, trades back to that. So if you miss this as an entry, there's your secondary entry, and there you go, it sells off. So if we go out to, let's clean all these up and go into a default and daily. You can see that we had the bullish order block in here, we had the fair value gap, the remaining portion of the BISI that needed rebalanced. And the swing low here, sell side liquidity resting below that, and that was mentioned on Wednesday. And then here's the distribution on Thursday, and a slight give back on Friday, which is normal. We do have a larger liquidity pool on the daily chart for Wednesday here, so we may see it still depreciate to 130.65. So that's something to be watching. It's still a couple hundred points, well, not quite 200, but very close to it. Over 150 points, just call it that even, and that would be a nice opportunity. It doesn't need to go below this one, but certainly watch it to trade into this one, because we have the mean threshold of this down close candle, which is a bullish order block. It may just need to go down to that before it has a meaningful bounce. The low here, watch and see if that does offer some measure of resistance. The down close candle in here, that could be a breaker, but I'm still thinking that we're heavy on dollar CAD and dollar index, so just be mindful that this may be the longer term, intermediate term, let's call it that, draw on liquidity for dollar CAD. Moving into the cable, if we go out to a naked chart, buy side liquidity pool is still in play. Above that, we have a slight little imbalance here. It takes us back up into the low at 128.25. And then we have a small remaining fair value gap there in that old low I mentioned weeks ago. That still might be the upside draw on liquidity. Should we continue to see the dollar index erode, and that takes us to 28.65. And I'm not looking bullish. I'm sorry, I'm not looking bearish on cable. I'm still bullish. And moving into euro dollar, we clean this up, take it out naked, daily. We have these relative equal highs, looking for a run to 14.50. Okay, so that may be the next intermediate term draw on liquidity. We did have our equal highs taken out. We mentioned that a couple weeks ago, and we see that now. It has happened here on Friday. So I'm bullish euro still, and again, that's the draw on liquidity I'm looking for. I don't want to go beyond that for now. Just know that we've had a really nice run from a fair value gap in here, closed, expand, equal highs. This is a setup in and of itself. If you just look for this pattern, fair value gap, optimal trade entry, equal highs as your target, that in itself is a complete system. Okay, that one's for you, Larry. Okay, you don't need all the minute details, because it's all explained in the mentorship. You want to understand money management? Go to the areas I talked about money management. If you want to know where the entry techniques are, well, pick one you like. Fair value gap, order block, consequent encroachment. The problem is you want me to give you the one that's going to be the silver bullet. This is the one that always works. None of my things always work, okay? Because you're going to demand an order block to supply you an entry. And it may not trade down to the order block. It may go to consequent encroachment of the fair value gap or a void. Okay, so think about it. I can't fix everything for you, because I don't know with absolute assurity that there's going to be a return to an order block, or that it's going to even trade back to the fair value gap. Okay, those gaps can become more meaningful if they don't get filled, because they become breakaway gaps and measuring gaps. Okay, and we got so much to talk about with that. It's just too much to go in one video. It takes a long time to draw all this stuff out. Again, it's 27 years come November. So, beautiful opportunity here if you're a position trader, if you're a swing trader, a little bit longer term time horizon. That's just not my cup of tea, folks. I don't like that. That doesn't fit my personality. But you were taught how to do those things in the mentorship. So if you can plug and play, which is what we do in mentorship charter level, you take the things that we've done in core content and place them together for price action models. That is your foundation for a trading plan. Once you adopt the trust in one of those models, or the theory behind one of those models, then you can start to begin to flesh those models out into a trading plan, which is exactly what we do in January 2020. I go back through the 12 price action models, and I give you what you're asking for right now, Larry, is the minute details about what to do to turn that into a trading plan, and then just stick to just that. The problem is you're still going to complain. Not just you, but some other folks that are going to be like, well, I'm trying to use price action model 3, and it's not giving me as many signals as I want, because now I'm looking at other things, and you're always going to have that problem until you control yourself. You are in the driver's seat. You can't be jumping around. Every one of my models will work on every time frame and every style of trading. They will absolutely do that. But you have to be in control over yourself. You can't just lose it because you saw your model that you're actively following right now not deliver today, okay, but you saw something else that was there, and then you say, well, I'm abandoning this one and I'm going to go to that one, and then all of a sudden 2 days later the price action models that you have been supposedly following or subscribing to starts giving you winners, okay, and setups, and all those things start taking place, and then you're like, oh, let me go back to that, and then it goes into that dry spell again, waiting for the setup to occur again. And that's what losers do. That's what retail does. We're not retail here, okay? So anyway, I just tossed that in for extra credit, no extra charge. So there's our draw on liquidity. I'm thinking we're going up there for euro dollar. And we go out to a daily chart and cleaned up for dollar index. We have this low here. That is 95.14. So we're looking for 95.10. Okay, 95 big figure. And if we really start to expand on the downside, we can challenge this old low over here at 94.60. Okay, so that's going to be it for now. We do have a fair value gap here on the daily chart, and we have this old low. So be mindful that if we ever trade back up into this week, 96.38, 96.35 would be enough, really, in my opinion. If we trade back to that, that could offer another opportunity or another round of selling and see it go lower. I don't think that we'll need to keep careening lower from here. It would be better to give us a little bit of a bounce, let traders think that they're finding some harmonic patterns in here or something, and then rally back up, create another level of premium, and then we can sell into that and then get another wave of buying foreign currency. All right. So now we're at the lesson portion of this week's video. I want you to study all of the highs that you see on your chart. Now, this can be done on any specific time frame. It doesn't make a difference what it is. But I want you to use the daily, 4 hour, 1 hour. Okay, just do those for now. And you're going to really be amazed by this. I want you to study whenever there's a tail and a wick. Okay, and very specifically what that is if you have a candle, the high part, okay, what makes the high of the candle, that line, not the body of the candle, that line, that's your wick. Okay, the thing below it, that little line, that's your tail. So we have a wick, and then we have a tail. During a swing high, and you're always going to be doing what I'm teaching you right here in hindsight, because I want you to see something and study it, and I want you to come back on Wednesday and see if you haven't figured out what the lesson specifically is on Wednesday's teaching. Okay, but I want you to study all the swing highs and swing lows, but I want you to study the wick on the highs on the daily, 4 hour, and 1 hour. And I want you to study the tails down here. I want you to study those on the daily, 4 hour, and 1 hour. What I want you to do is I want you to measure the tail, and I want you to measure the wicks. Okay? Get where the body ends and the wick ends. That's your range. Okay, and you want to get where the body closes to the tail end or the low of the candle. You want to measure that, and you want to project that out in time. You want to use a 3-day extension period. That means what I'm telling you to do is whenever you see a candle on a daily or a 4 hour, 1 hour, and you find a tail or a wick, you want to take that range and extend it out in time 3 days. Okay, so what you're going to do is have that range extended out in time and write in your notebook the observations you had and see if it doesn't match up with what I'm going to teach you on Wednesday relative to this signature and price action. You're going to like it, I promise, but for now, you have to do a little bit of homework, study it. Don't be frustrated if you don't really see anything. It's okay, especially the newer folks. Charter members from 2017, you might pick up on it. The newer level 2018-19 group for charter, you may not get it. Some of you may. The newer folks absolutely will not get it. And I might be surprised, maybe you do. But nonetheless, take that range on the tails and the wicks, extend it out in 3 days. Okay, and study that and see what you observe in price action at that time. In other words, after the wicks and tails form on the daily 4 hour and 1 hour, extend it out in time. Whenever you see those next 3 candles form, study that. How does price react in there? And I'm going to teach you that specifically on Wednesday. Until then, I wish you folks a very pleasant weekend. Be safe, and I'll talk to you on Wednesday.